sort of a weird scheduling blip here where we only are 2 weeks since our last class, and our next CFP class anyways is going to be quite a ways off. So see how that works out for us. The agenda today, we have trusts to finish out. We'll do a little bit of discussion around multiple choice questions on this exam. When I originally scheduled the course, I wasn't really thinking about how much we would have done on the other course on multiple choice. So I'm less concerned about this now than I was when I originally scheduled this. I still do have some comments around multiple choice though, and we'll get there. We'll do the homework, and time permitting, we'll do IPPs and RCAs. And then as usual, I have a new bit of homework for next class as well, an assignment with an IPP and RCA component to it. I'm going to caution you right now that if you try this homework, I sure am, yeah. It's not, in fact, Shauna, your sound is not working. Your audio is not connected. Just give me a second here. Okay. Baljeet, you're off mute right now. I'm not sure why you can't hear me. I don't know what's going on there. Okay, perfect, Shauna. That's good, Baljeet. All right, so you're still off mute though, Baljeet. Just if you're tracking. Okay. Yeah, so if you try the IPP and RCA homework without having first brushed up on these, this assignment will end in whatever tears, frustration, cursing, some NSFW outcome, I'm not sure, but you must brush up on these concepts unless you do this all the time. And I would be shocked if that's the case, okay? Is there anybody on the call who does that all the time? All right. Is there anybody on the call who's done one IPP? Kevin, IPP? Anybody? Okay, there you go, Connor, right? And that's not surprising. They are, look at Kevin, same answer as Connor, right? They are sometimes a good starting point for a conversation, and then either, and I'm sure this is what happened with both Connor and Kevin's experience, either cost or complexity pile up and we decide not to go the route. That be fair? Yeah, all right. That is not surprising at all. Okay, I did, actually, Baljeet was good enough to send me a question on email, and this led me to, and there's a couple of these. I was aware already, Baljeet, of what you emailed me, but I thought it was a nice question. So there have been 2 recent estate planning cases. This is not directly relevant to the exam, but there is some stuff in here that's potentially useful. 2 recent estate planning cases that have both brought out I think valid questions about what we're doing when we put together an estate plan. So I put together a little video for it. You can watch it or not. It's not, no, you wouldn't have, oh, I guess I sent it to you late last night. But anyways, yeah, it's not something that I would go through in class, Baljeet, just because there's nothing there that is straight up examinable. Okay? And honestly, there's some stuff in there that's potentially confusing for an exam question, but it's okay. It's worth watching, and there is some relevance to the, especially the CFP exam. Okay. Are there any questions before I get into my stuff? Any outstanding? Yeah, because it's interesting. It's interesting. I honestly don't think it's, I mean, first off, I don't know if you know this, Baljeet. Investment Executive and Advisor.ca are owned by the same parent company. They're both part of Transcontinental. Are you with me there? So the articles they publish are the same articles, right? I don't know if you've noticed that or not. It's not a coincidence, okay? And then I assume the third you saw it in was Wealth Professional. I canceled my subscription to Wealth Professional. I felt like they, I don't want to get into a whole political soapbox thing, but I think Wealth Professional collectively has a really lousy attitude about dealing with women, and I canceled my subscription there. So I assume that's where else you saw it, and I don't read Wealth Professional anymore. All right, so, okay. And I'm not airing dirty laundry here. I have approached the editors of Wealth Professional directly, and they have chosen not to acknowledge my comments. So, whatever. All right. Now, I guess I don't know how, whatever. All right, I don't want to go down a path here. Anyways, so are there any other, the marks for none, Trevor? I would expect none. Is that fair? However, if you have one question is going to be this kind of question. So it definitely fits into that. Remember my comments before about questions in your wheelhouse, questions that are a little bit uncomfortable, and then questions that are straight up just in the WTF category. So I would expect no questions, but that doesn't mean there won't be one, right? Does that make sense? So there's going to be, whatever, pick 20 complicated concepts. I don't know which of the 20 complicated concepts are going to be on the exam, but 4 of them will. So I guess if I'm gambling, I would say there's, I don't know, call it a 20% chance of seeing IPPs and RCAs on the exam. Is that fair? Okay. And I still think that it's worth brushing up on them. You can't get through the exam without getting at least some marks on those more difficult questions. And this tends to be an area where people just have no comfort at all. So you have to show up with at least some degree of comfort. And the nice thing is, at least with the IPP, the big thing to know here is that structurally, okay, an IPP is a defined benefit pension. Okay, so if you're working through an IPP question and you're not sure about some answer, think to yourself, how would this work in a DB pension? Okay, does that make sense? And that really is the case. That's the thing that people often lose sight of, that what you're doing with a DB pension is the same thing you're doing with an IPP, just that with an IPP, you're only setting it up for, now the name says individual, but that's not quite accurate. Okay, that you can have a maximum of 4 non-connected persons, which are non-family. Okay, or if they're family, then there's effectively no limit on the number of persons who can participate. Okay, does that make sense? All right, so really, anytime you see IPP, first off, just go straight to DB pension. Almost everything that we learned with DB pensions applies to an IPP. Okay. And that very much ties into when Connor and Kevin said earlier that they had considered IPPs in some scenario and found that cost and complexity were too much. That's the same thing that keeps employers away from DB pensions. Okay. If you had a who does a lot of group retirement work? Does anybody in the call do a lot of group retirement work? Yeah, perfect, Melanie. Okay. Last class and the class before, Connor, we did DB pensions. Okay. Yeah, so Mel, what would be your biggest group? Would you have a 100 life group? Maybe a 200 life group? I'm going to assume somewhere in that category. A lot of group RRSP work in that range, right? Okay, perfect. So let's say, would you do a defined benefit pension for a 100 life group? No. And it's exactly those reasons, right? Cost and complexity are too high for a 100 life group, aren't they? Okay, so you would probably need somewhere around 800 lives, thereabouts, before you would do a DB pension. It's very much the same discussion as with an IPP. That cost and complexity is what keeps them off the table. All right. Any questions? I know that was all my stuff. Any questions then from the crowd here? All right, perfect. I think I'm going to, I don't know. Yeah, I have a comment about that in here somewhere, Vaishali. Yeah. Well, generally, Baljeet, that you have somebody who makes at least $100,000 a year and is at least age 45. That's your starting point. That's your bare minimum starting point. There's a whole bunch beyond that. We're going to talk about that when we talk about IPPs. Okay. All right. I just wanted to give you some ammunition so you can answer those questions. Okay, so today we're going to finish trusts. We're going to talk about multiple choice testing on this exam, and we're going to do IPPs and RCAs, time permitting. All right. I'll be surprised if we get too far into IPPs, honestly. With the other class, the combined class with the QAFP students, we're together again in a couple weeks on the 26th of August. And that's where we'll do some just very, very fundamental income tax stuff, deductions, credits, income. And we'll talk about memorization on these exams and really a lack of need for memorization. Those that have either written the QAFP exam are quite aware of that. Okay, same schedule as per. We'll take a break in about an hour and 45 minutes, and then we'll be done in about 3 hours 45. Okay, so as per Vaishali's question, FP Canada sent out their plan for exam administration. I think last Tuesday it was. Okay, and you have a couple of choices here. So first off, CFP exam administration is going to be over 3 days. November 24, 25, 26. I believe that's a Tuesday, Wednesday, Thursday, if memory serves correctly. You can read the full details at the link, which is hyperlinked here. You should have gotten an email from FP Canada. If you didn't get an email from FP Canada, check your junk mail, but if it's not there, then you're not on a list you should be on. Okay. And what's happened here is there's actually fewer live exam centers than normal. So they're cutting back on the number of live exam centers. Okay, I don't think that's true, Melissa. When I looked at it, I saw Lethbridge, Calgary, and Edmonton. I did not see Lloyd on the list. Okay. Okay. Yeah, I'm sure that it's just Lethbridge, Calgary, Edmonton. Okay. No, it is Lethbridge, Calgary, Edmonton. Baljeet. Yes, right. Okay, I mean, we can have a look at it, but I did look at it yesterday. All right, yesterday. I looked at it recently, might have been, I don't even know what day it is today, Tuesday, that's right. So Calgary, Edmonton, Lethbridge. Okay, and Saskatchewan. I don't see Lloyd on here at all. All right, and Regina, Saskatoon. So if you're in one of those centers, I'm going to assume wow, that's funny. So Kenora is an exam center, which I'm glad they actually put it on the Manitoba list. That actually kind of makes sense in a really weird way. You'd think it would also show up on the Ontario list, but anyways, no Grand Prairie still. I've been fighting for Grand Prairie to be on this list forever, and they just won't do Grand Prairie for me. Yeah, honest, if you have the choice, Shauna, I would suggest an in-person exam center, only because if there's any troubleshooting to be done, you're not going to be the one doing it. Okay, and just the nature of these exams is such that there will be some group of you for whom some troubleshooting is required. It always happens. Okay, I'm not aware of a single iteration of this exam that has been completely trouble-free. And that's not just a pick on this exam. This is true for virtually any of these centrally written or centrally administered proficiency type exams. Okay, so the in fact the CPA exam, the most recent iteration of the CPA exam, the whole thing went down the toilet. The whole exam rate went away. Or the most recent CFA exam, they released results early on a faulty basis. So you get a lot of problems here. And I would think that it would just be nice to have that exam proctor who can fight those problems for you. You can just sit back and relax. Okay. No, so the way they do it, Connor, this is actually a very common thing. This has been done for 4 or 5 years. What'll happen for those who write at home, so if you're going to choose to write at home, or if writing at home is better for you, and for some people it will be, okay? So if you're going to write at home, what'll happen is you'll sit at your computer at your kitchen table or something like that, and you'll have to have, and they say it in here, you'll have to have the walls around you with nothing hanging on them, so they'll make you take down any art or calendars or anything like that that hangs on your wall. Okay, you'll have your camera on, and you will pick your camera up or your phone up, or sorry, your computer up, and you'll turn it around 360 degrees. And then while you're writing, there's actually a proctor. There's actually somebody who's sitting watching you write, and that person will be assigned 4 people. That's normally how these things work. I can't say for sure that that's how it works, but I know the company that's proctoring this, and I know this is their standard, is that person will have like a security camera. They'll have 4 people that they're watching. It's technology assisted, so they use, and you'll have to enable some sort of a tracking. There'll be some like spy thing that they put in place to watch where your eyes are going when you're writing the exam, so they can see if your eyes are looking away from your computer for an extended period of time or whatever the case is, and that'll flag something for the proctor, and then they'll watch you more carefully. At some point in there, probably 4 or 5 times through the day, you'll have a piece of ID, your driver's license or passport, and you'll hold that up for the proctor, all that kind of stuff. So it's going to be fairly diligent. You're going to want like a small, clean room in which to write. And yeah, that's it. It's not too bad. I've got experience with this kind of thing, and it's not a terrible experience. Baljeet's right that if your home internet is shaky, then maybe this isn't an ideal circumstance. But they know that there are people all across Canada writing these exams, so I wouldn't be scared to write at home. But if I had the choice, I would probably go write in person. Now, keep in mind, when you go write in person, you're probably going to be subject, like in Edmonton. Yeah, so now, Michelle, you could write in your office. If you had an office, you could do that as well. So writing at home doesn't necessarily literally mean writing at home. It means writing in some clean, uninterrupted space. But yeah, if you have whatever 4 little kids at home and you just can't set it up so that you could be home alone all day, then yeah, don't do that. Okay. I don't know what the scrap paper situation is going to be, Jennifer. I don't even know what it is for the regular exam centers, okay? So when they do their conference call, I'll ask that question. I would encourage, honestly, for those of you that wrote last time, I found the lack of scrap paper quite frustrating, and I hope that people have made that comment as well. I hope that they fix that this time around. So you should be allowed scrap paper. I don't know how they're going to do the booklets. I assume what they're going to do is mail you the booklet package in a sealed envelope, and they probably will just have you uncork it on camera the morning of. So there'll be a seal on that. You'll show it to the proctor. You'll break the seal, open it up, take out your exam materials. I believe that's what they're going to do. Okay. Does that all make sense? Is with me there? Yeah, I think that's what you'll see. Now, again, that's all speculation. They will do their conference call in early October or late September. So they'll have a conference call about this, and you'll get more details then. Oh, I didn't notice that, Kamal. All right. So it'll just be online then, I suppose. You'll just have your booklets online, okay? Which is not necessarily ideal, but everybody will be writing under the same circumstances, so at least you have that. Okay. So that's why they're spreading it over 3 days, Baljeet. The booking schedule will match the proctors that they have available. Okay. All right, that's fair. So whichever it is, and I mean, the nice thing is you have time to prepare for whichever. So if you find that if you know you're going to write it at home, then get used to studying that way too, right? So then start working from just one document on your computer screen, stop printing stuff off. All right. And probably you won't be allowed 2 monitors. I'm going to guess that's the case. I'm going to guess that you're going to be capped at 1 monitor. So you might have to get used to something different that way too. All right. Perfect, Shauna. Yeah, that's good. All right. Yeah, 1 monitor only. There it is right there. Perfect. Okay. Any other questions about this? So I would register as soon as possible. You don't want to be waiting until the last minute to register. There's no benefit to waiting to register. You get the early bird pricing and save yourself $100 if you register now. And you will, you can see all the listing of stuff right here. Okay. So yeah, get yourself registered, and that way you'll have lots of time to think about what the exam environment is going to look like. You do, Pamela, yeah, that's right. So when you register now you potentially can change later on. So if you're not sure yet, and I don't know exactly what's going on, Pam, that you would be uncertain, but if you're not sure yet, maybe you do wait to register. I still think you're better to register sooner rather than later. Okay. But yeah, you might find it's difficult to change later on. All right. Good. And I will say it again, if you're expecting a completely seamless experience on exam day, where the technology all works absolutely perfectly for every single person, there's going to be some of you that are disappointed. I hope it's a smaller number, but one of the things that I do encourage in my exam prep classes is that you're prepared for technology disruptions. Okay, that's good. It's not something you'll be able to change or fix or whatever. It's just something that is going to happen, and you're better off to roll with it than you are to fight it. There you go, Shauna. So if you're resilient with those tech issues, that's good. If you, I don't know, regularly go through computers because you're smashing them into little pieces, like in Office Space, then maybe you want some sort of counseling before you get there. All right. All good? Okay. So, yeah, I think that's it. Should be nothing else there. All right, so last time we left off, we had just introduced trusts, okay? And I had really introduced them from the perspective of why do we use trusts? Why not just give the person in question the property? And some of you reminded us that the key question here is who do I not trust? Or if I want to sum that up, I would say trust means no trusts, okay? That is, who do I not trust, okay? And what happens then is that we're looking for some reason why I might not just give that person that property directly. If I can't find a reason not to give that person the property directly, then I should just give them the property, okay? And despite what you hear still quite a bit today, there are almost no tax benefits to using a trust. Do you have a question, Tracy? Or is that just an accidental unmute?
Accident, sorry.
No problem. All right. So the see, there's this technology issues, right? That's an object lesson, Tracy. I like it. So the tax benefits of setting up a trust are minimal at best. And in fact, there can be some tax downsides to setting up a trust. All right, and if you're looking to brush up on your trusts, then you can look at Chapter 6 of Advanced Curriculum and Chapter 6 of Core and Chapter 15 of Core. Oh, I got it. That makes sense. Yeah, sometimes it does that. All right. So, so when am I using a trust? I have to slide in here twice. Okay, so let's look at the basics of a trust. So what are we doing here with a trust? Well, first off, we have to meet what are called the 3 certainties. Okay, and trusts sort of work on this rule of 3s. We've already seen with a trust that we're going to have 3 parties. We're going to have the settlor, we're going to have the beneficiary, and we're going to have the trustee, or we might have more than one settlor, we might have more than one beneficiary, we might have more than one trustee. But anyways, there's those 3 entities, and we also have 3 certainties with the trust. So my 3 certainties are that we have to have a certainty of intention, we have to have a certainty of subject matter. How is it when I type? I've got a new audio arrangement here, and is the typing disruptive? Okay, good, let me know. Okay, perfect. So I'm hoping, yes, I'm hoping that it hasn't changed how it looks, but I guess I got it. All right, so certainty of intention means that it's clear that I was trying to establish a trust. Okay, that is something for somebody else. Now I'm going to talk about some more examples of this in a moment here. Certainty of subject matter says that I can identify who the trust is for. Oh, sorry, I apologize. I can identify what property is in the trust. So I have some firmly identified property, and certainty of objects is that I can identify who the trust is for. Okay. So with different kinds of trust, there's going to be different sort of versions of this. So a very common type of trust here in high net worth and sort of family business situations. Okay, so very common trust here. We're going to have the settlor, and usually in these scenarios, somewhat unconventionally, but normal in this scenario, is the settlor is usually a family advisor who is not directly connected, not a family member. Show why in a second here. So that's one of the three parties. We're going to then set up the trust. A trust, because it has these three elements, is represented with a triangle when you're doing an org chart, flow chart like this. So my settlor is a person, usually, although it theoretically could be a corporation. That's not too common. And then I'm going to have my trustee or trustees over here. And that could be a person or it might be a corporation. Not uncommon to use a corporate trustee here. And this person or this entity is going to have usually a fair bit of discretion or even full discretion, so usually absolutely discretionary, which means that the trustee makes all decisions. Okay, and then our beneficiaries, and this is going to be a whole raft of family members, possibly including spouses, kids, grandkids, whatever the case is. Okay, and the property that we're going to settle into the trust, that is our subject matter of the trust, is typically going to be, let's say, a $20 bill. That's only what you're going to use here when you settle a family trust. Or sometimes a $10 bill. It doesn't matter. I don't want to quibble over $10. Okay, that's good. It's really just a question of having some relatively nominal value here, but a piece of property that we can firmly identify. So with this family trust, I have met the three certainties. Okay, the intention is to create a trust. There's a written document describing this trust. And it really means that there's no question about intention. Okay, then subject matter. So I have the $20 bill, although that's not really what we're splitting. What's really going to happen here, once the trust is set up, that's where the trustee or trustees are going to borrow money separately. And really, as the trust, not as themselves, borrow money and acquire property. And usually it's going to be newly issued shares of the family business. But that's not what's settled into the trust. The trust is usually settled with that $20 bill. Okay, does that make sense? Yeah, exactly. Done as part of an estate freeze. That's, again, normally you're going to see the this family trust scenario coupled with an estate freeze. Exactly right, Tracy. Yeah. And my certainty of objects here could be a section 86, it could be a section 85. I don't want to get into that here, but yeah, it could be an 85 or an 86. In fact, it's probably more likely an 85 freeze than an 86 freeze, Tracy, but it could be an 86, not to dismiss that possibility. And then I have my certainty of objects, and that's that whole raft of people. The settlor had a $20 bill, Baljeet. That's what makes them the settlor. And yes, they were able to use that $20 bill to settle the trust. Okay. And the object of the trust, that's going to be that raft of family members. Okay. Now, I could call into question the intention of this trust. So let's say I did things differently. Okay, just for the sake of argument here. Okay, let's say Dad is the business owner and Dad settles the trust. Okay, and Dad is a beneficiary of the trust. Well, now I've created what's called a revocable trust. That is where the question would be, did Dad really intend to create a trust, or was he just parking something here to hide ownership or to create some beneficial tax consequence? If those things are true, then we really don't have a trust because there's not a clear intention. So this would muddy the question of intention. And it's probably not a trust at all. Does that make sense? Okay. Now that's possible, Baljeet. It's possible that Dad does not trust himself, but if he didn't trust himself, okay, then I would suggest, now you can have an alter ego trust that works like that does exactly those things, but in this type of trust where I have other beneficiaries, I would really question whether a trust has been created at all. Okay. That's good. The difference with the alter ego trust, Baljeet, which is legit, that's where Dad does not trust himself, is that in the alter ego trust, Dad is going to be the only beneficiary of the trust, the only income beneficiary of the trust during his lifetime. Nobody else can benefit from that trust, whereas here I've got the other family members, and that really is part of that muddying of those waters. Okay. Now, I can have what's called an informal trust. Okay, or sometimes we call this an in trust for investment account. And I'm sure a lot of folks on the call have experience with these types of accounts. Very common to see, not necessarily high net worth, but let's call it mass affluent folks, folks who have exhausted all their RSP room, maxed out RESPs, whatever the case is, where they set up this type of account for their kids. Would that be accurate? I'm sure that there's several of you on the call have dealt with this. Okay, so this is a little bit different. The difference here is that we typically have no formal trust document. Is that fair? Mel, Shika, when you set these things up, you're not sending your client to a lawyer to get a trust document written, right? Okay, so that's why we call it an informal trust. So there is no formal trust document here, but we're still doing the same type of thing. I'm going to have a settlor, which is maybe mom or dad or both. That's okay. And then we're going to have our trust created. And usually this is done with some sort of non-registered investments. Okay. And then I'm going to have a trustee or trustees. And this is usually mom or dad as well. Okay. And that's going to be mom, dad, or both. Usually it's rare, unless you're dealing with very high net worth scenarios, it's rare to have any other trustee here. And then you're going to have your, usually it's going to be, I'll say, one beneficiary, and this is going to be one of the kids. Okay. So it could be something other than investments, Pamela. It can't be RRSPs. It can't be TFSAs. It can't be, it can't be, what have I missed there? RDSP or RESP. None of those assets can be held in trust. They're already trust accounts, right? Yes. So it's, when I say usually non-reg investments, it could be cash, right? So it could just be cash we settle in here. I could arguably do the same kind of thing with real estate. Okay. All right. So it's the investments where they usually belongs, not the non-reg where they usually belongs. All right. So now do we have the three certainties? Have we met the three certainties? Okay. This is the little trickier. Well, I'm not necessarily going to agree with this in all cases. So first off, subject matter is clear. Okay, I can tell what the subject matter is. It's those non-reg investments. Okay, that's good to go, right? Objects are clear. Maybe. Okay, I'll talk about why in a second. It's for the kids, right? Or for the child. Okay, and intention is clear. Maybe. Again, it's for the child. Okay, so here is my question. What if the child gets to age of majority and is a complete dirtbag? Okay. Do mom and dad take the money back? Or do mom and dad leave the money in the trust for the kid? And at this point, now this depends on the province you're in. Some provinces, so Alberta, for example, we don't have what's called the rule in Saunders v. Voce, but most provinces do, where the child at age of majority can just get the money. Okay, so you tell me, are the parents going to take the money back now? Okay. So then it was never a trust. If they can take the money back, now they can stop payments, Baljeet, but again, if the child pushes in BC, for example, if the child is age of majority and they say, I want my money, if we've set up a trust, the child can take their money at age of majority. Okay. I don't want to get into, we'll talk about that in a second, Tracy. We'll talk about attribution. That's not consequential here. Okay. We're not talking about taxes at all yet. All we're talking about is ownership. And this is really the true statement. Okay. What I have in green on the bottom right is exactly right. That if the parents can take the money back, this was never a trust. Okay. Who paid the tax on it, Connor? Well, then why did they set up a trust, I guess? That again, though, Connor, don't confuse the tax issue with the ownership issue. Those are not the same thing, right? And we'll talk about the tax right away. Okay. They definitely were using after-tax funds to contribute to the account. There's no rollover of funds going into the account. Okay. Right, so that's exactly it, Vaishali. The fact that it's a revocable trust means it's probably not a trust at all, and that's where I would suggest that we didn't actually create a trust. Okay, that's good. Is everybody with me there? All right. It has to stay in the trust or go to the kid, Baljeet. Yeah, if mom and dad can take it back, it's not a trust. All right. Honestly, and I know everybody on the call, or not everybody, many of you on the call have done these kinds of things, but this is really a risk with these types of trusts. You're deliberately avoiding the use of a lawyer to go and get advice about this trust, and deliberately avoiding the formal trust document. Well, you're counting on trust law, but you're not setting up the structures behind that. No, I wouldn't agree with that, Pamela. I would still say the only difference here is what age is the child entitled to that money at. Okay, so in British Columbia, the child would become essentially automatically entitled at age 18. In Alberta, the parents might be able to push back for a couple more years. Okay, I thought age of, I know your voting age is 19, Pamela. I thought age of majority was 19, was 18 in BC. Sorry. Okay, but if it's 19, that's fine. All right. Okay, so that would be, all right. Thanks, Pamela. All right. Yes, if the child, if it's beyond a dirt bag, Kevin, that's why I say a dirt bag, because I'm trying to establish that there's still mental capacity there. If the child has mental capacity, then you're not going to win that argument, right? You're not going to be able to get the child declared incompetent. Um, I don't understand your comment. Sorry, Connor. I don't know what distinction you're making here. So, Shauna, if the parents wanted to do something like that, they should have gone to a lawyer and gotten a thorough draft or a thoroughly drafted trust document that would establish those intentions. And then, yes, you're probably okay. So you could do that, but that has a cost, right? That's where you're going to have a real full-on trust associated with it. Okay. Okay. Oh, I see. No, no. When you die, so when you set up a trust, it is what it is. So they set it up. It's an inter vivos trust. It's always an inter vivos trust. Even then, making it into a testamentary trust doesn't change anything. There's no tax difference between an inter vivos trust and a testamentary trust, unless you're talking about the graduated rate estate trust, which this could not be. Okay. That's good. Okay, so this is not an insurance proceeds scenario, Baljeet. That's a different question. We can talk about insurance proceeds in a trust. So Ron has a similar question here. Let's park that for now. And I'm happy to talk about insurance proceeds in trust as well. That works nicely. That's a good question to ask, but let's deal with that separately. So Shika, if I change the beneficiaries later on, now let's look at our three certainties. Okay. So now, have I met certainty of objects? If I can change the beneficiaries, have I met certainty of objects? I have not, right? Therefore, I have no trust, okay? Okay. Now, I just want to talk about taxes for a moment here. We haven't talked about taxes hardly at all, but a trust does not get around attribution. So if this trust generates dividend income, for example, who is it taxed to? That's it. It's taxed to the parents. Yeah, it's like the trust doesn't exist. It's a flow-through structure, Chris, right? It's like the trust does not exist for tax purposes. All right. Yeah, perfect, Shika. If it generates capital gains, those go to the kid. which would be true without the trust. Those would be exactly the same circumstances if mom and dad just gave the kid money to invest. Okay. It's taxed to the parents, Connor. It's taxed, that's all, it's taxed to the parents, or if an aunt or uncle sets this up, it's attributed to the aunt or uncle or grandparent. Okay. So it's not necessarily to the settlor, although practically it probably is. Okay. Yeah, that depends on the type of investment account, Shika. That depends on your own compliance rules. It depends what you're looking to hold in that investment account. So that would be one reason to do this if we're restricting that child from being able to open an investment account. And remember, Shika, that's one of the reasons that you all told me last time we're together for using a trust, right? Is that somebody can't own property? Okay. So in any trust situation, you should be asking, are the three certainties met? Are we good with that? Okay, perfect. No, it's taxed to the parents because they're the parents, Ron. So now it depends who gives that kid the money, right? But the attribution rules are that when that minor child earns dividend income, it's going to be attributed to the parents unless the money came from grandparents or aunts or uncles. And no attribution after death, Beljeet. So if this was after death, which it's not, right? But if this was after death, there's no attribution. Okay, that's all good. No, if it's to the uncle, then it would be attributed to the uncle, Connor. Okay, so the uncle said it, it's attribution to the parents unless it was set up by the uncle, aunt, or grandparents, then it's attributed to that person. Okay. No, I don't know what you're asking me here. I don't want to say it's the same. It's not, that's not a good way to phrase this. If the parents were the source of funds, then it's going to be attributed back to the parents. If the aunt or uncle was the source of funds, then it's going to be attributed back to the aunt or uncle. If the grandparent was the source of funds, it's going to be attributed to the grandparent. Okay. That's good. To the donors. Donors is the word you're looking for there, Baljeet. Okay. All right. But it's not, okay. So Connor, that person may not be the settlor, right? That's, so don't make that, you're trying to make a rule where there's no rule. Okay. That's, you can't, you got to be careful with that, right? I gave you the rule, but you can't superimpose another rule on top of that. So just as an example, okay, if mom and dad, let's say for the sake of argument, mom and dad put, and this is where it's such a nightmare, Connor, okay? Mom and dad put $10,000 into the trust. You with me here? Okay, so now any income generated on that $10,000 is attributed to mom and dad, but then let's say that later on an uncle comes along and adds $5,000 to the trust. That is possible. Now, any income on that $5,000 is going to be attributed back to the uncle, but the parents are still the settlers of the trusts. Okay, so Shika, you're trying to do the same thing here. Don't say the settlor is responsible. It's what I said earlier. Okay, it's mom or dad, or the aunt or uncle, or the grandparents. Okay, and interest income is also subject to the same attribution rules, Shika. Okay, all right, that's all good. So Devin, who has responsibility for demonstrating the outcome here? Who is the onus on to demonstrate the source of funds? It's always on the taxpayer. Okay, it's the taxpayer who has responsibility. Okay, so if you have a child who has who's a beneficiary of a trust like this, and that child starts to report income, so that child files a T1 this year or T5001, whatever, they file their income tax package, and it shows whatever $500 of dividend income for a 12-year-old. Well, that's where CRA is most likely going to come back to that and say, hang on a second here, that $500 of dividend income for a 12-year-old doesn't make any sense. We're just going to attribute that to the parents. Okay? And unless they see a reason not to, then that's just the automatic approach they'll have to it. Okay. Yeah, I think I said that already, Stuart, didn't I? Didn't I already make that comment? That there are almost no tax benefits to a trust? Yeah, okay. Yeah, that's true, Baljeet. The trustee should be taking care of all the documentation. The onus is always on the taxpayer to retain records to demonstrate that their tax position is what they say it is. Okay. Yeah, 100%, Connor. That definitely happens. That's something that I hope people are taking away from this, that a lot of the informal trust structures you see out there really are not good and present clients with some tax risk. Okay. So Baljeet, the trustee is responsible for any tax work on behalf of the trust itself, but they'll produce a T3 that then goes to the beneficiary. The beneficiary is still a taxpayer. They are responsible for filing their own tax return. The beneficiary doesn't get their taxes filed by the trustee. Okay. And a trust itself is not a taxable entity unless it has taxable income. So that the trustee may not have to actually file any tax returns. Yeah, we're going to talk about taxation a little bit later on, Connor. Yeah. Okay. We're going to do an insurance trust first, though. All right. Okay. Well, I like your thinking here, Lance, but there still is such a thing as an informal trust. It's always going to be the question. Okay, this is the question that you should be asking before you set one of these things up. Okay, is this question of what if at 18 the kid is a dirtbag? Okay, and if the answer to that question is we're still going to give that kid the money, then you probably have a trust. If the answer to that question is no, we're going to take the money back, then you probably never had a trust. Okay. Yeah, so we did that example, Baljeet, right? That's the whole left-hand example, right? Okay. All right, can I erase this slide? That's kind of the case, Ron. Potentially, Shika, we'd have to know a lot more to be able to make that assessment. I don't know if I'm comfortable saying that, Shika. Oh, well, so that's where, yes, if they intend to take the money back, then we never had a trust and potentially have a reassessment of any sort of tax benefits that you ever did get by using the trusts. All right. The trustee always has that option, Devin, with any income that the trust creates. So the dividend here would be attributed to the parents, but if there's a capital gain, if the trust creates a capital gain, the trustee has the choice whether or not to have the trust pay tax on it or to have the beneficiary pay tax on it. If the trust pays tax on it, how is it taxed though? Now remember that a trust has income automatically taxed to the top marginal tax rate, right? So in Alberta, that would automatically be at 48%. In Ontario, it'd be at 54%. In BC, it'd be at 51% or whatever you're at now. Okay. If the trust pays tax, it's paying tax at top marginal tax rate. Yes, most likely, passing the income to the kids is going to result in less tax payable. Okay, that's good. All right. Now, let's have a look at the insurance trust. A couple of good questions here. Chris just sent us down this path again. So yeah, this is a fairly common type of thing. Many of you on the call have potentially dozens or maybe even hundreds of these sitting as potential trusts in your client files. So you've got this type of scenario. You've got mom and dad. Okay. And let's say, just for the sake of simplicity, each takes a T20 life insurance policy. Okay. For $1 million. And they name each other as beneficiaries. Okay. And they name, let's say, their 2 kids as contingent beneficiaries. And at the time they write the policy, the kids are minors. When the insurance is placed, that's good. So there's also a trustee. And let's say each names the same whatever aunt as trustee. Okay. Everybody's good there? All right. And for the sake of argument, we'll have Allison here. So now, mom and dad die. Let's say, for the sake of argument here, mom and dad die. In the same accident. Okay, safe falls on both of them. And the kids are 15 and 17 when this happens. Okay. Everybody's with me here? So now we're going to create a trust. So what'll happen is we probably create 2 separate trusts. Not that it really matters, but we're going to see something like this, okay? Where we're going to have the settlor is going to be mom, and then there'll be another one with dad. Okay, and this is a testamentary trust because it was created at death. However, there's no tax benefit to this testamentary trust. It's not a graduated rate estate trust. And the reason it's not is because a GRE has to be created by will. Okay, so there's absolutely zero tax benefit here to this trust. All right. Everybody with me so far? And now we're going to have this $1 million sitting in this trust. This $1 million, it's going to be invested. Now, the trustee, name who, Sanjay? What's the names you're thinking of here? I'm not clear on what you're asking me. Sorry. If there's no trustee named, then it's going to go to the public trustee. Okay. No, there's $2 million policies, Richard, so it's still going to be $1 million in this trust. Okay. Right? So there's going to be $2 million trusts, two $1 million trusts. So the trustee invests according to the prudent person or prudent investor rules. Okay, and this is by provincial trust law. And basically what it's going to do is it limits risky investments. Okay, the sort of typical version of this, and not that we care too much, but a typical version of this would be something like you can't invest in any stocks that trade other than on the TSX. This is actually pretty common. And minimum $5 share price. So that would be sort of the perception of risk here, and any bonds must be investment grade. Okay, that's a fairly common interpretation of the prudent investor or prudent person rules. And then you would have to do a proper asset allocation that's going to make sense for these beneficiaries. Okay, and that would depend when the money's expected to be used. If they're going to use some of it for school, you would asset allocate properly for education. If you're going to use some of it for buying a house, you would asset allocate properly for that. If it's all retirement money, you would asset allocate properly for that. That's really going to put a lot of onus on the trustee to get this right. Okay, these prudent investor rules are actually fairly challenging. Okay, hang on to that, Sajay. You're a step ahead of me here. Just give me a second here. All right, we'll get there. All right. We haven't even talked about our beneficiaries yet. So then I have my trustee, and Allison. Okay. And she is going to be a fiduciary, which means she has to place the kid's interest ahead of her own. Nothing to be sorry for. Just we'll work through it here. So as the kid's interest ahead of her own, means that she follows those prudent person or prudent investor rules, that she has to really take care of the kids. However, this is going to be muddied a little bit because she's going to have absolute discretion. Okay, which means she makes all decisions. There are no limiting factors here associated with this trust. Okay, that's good. And the issue here is she's potentially on the hook for the decisions that she makes. Okay. There's no inherent remuneration here, Sanjay. She can't take any sort of remuneration unless a trust document specifically gives her the right to do so. Now, she can recover her direct expenses. Okay, so if she pays an accountant to do a tax return, she can probably use trust funds to pay the accountant. but otherwise it is literally a thankless job. Yes. Okay. So, and honestly, she probably falls under the suspicion of other family members doing the job. So it's potentially even worse than that. Okay. So when she has this absolute discretion, that doesn't really change anything, Baljit. Okay. And I know a lot of lawyers who would prefer actually to have one person as the trustee and another as the guardian. Okay. That's good. So you may actually deliberately divide those two things up. So let's say, for the sake of argument, when the kids are 15 and 17, okay, and the guardian, okay, let's say it's a different person, but it could even be the same person, Baljit. It's not really material here. The guardian who is responsible for these kids maybe, I'll use a, okay, so doesn't have a, say, a livable basement, okay, and no other space in their household for this person. They have their own kids or whatever the case is, maybe they have younger kids and there's no room for the 15 and 17-year-old. They say, well, if I finish the basement, okay, let's say at a cost of $40,000, then I have 2 bedrooms for them. Okay, so now if you're Allison, is this a good use of that $40,000? Okay, Baljit says yes. Would anybody disagree with that? Shika says yes. Kamal says no. And in fact, this is what's going to happen. Okay, is there's going to be some who say yes and some who say no. There's going to be an it depends answer. There is no right answer to this question. Okay, and that is just how it is. I don't know what the answer to this is. Okay, and this is where you get into a potential problem here, that at some point later on, if the kids take exception to this, the kids say, well, in fact, the homeowner really benefited from that. We only lived there for 2 or 3 years. This person could have sold their home, could have rented a slightly bigger house, had a home for us for 2 or 3 years, and then repurchased a home, got back into the market. It's not fair that they impoverished our trust to do this. Okay. Well, that's the point here, Ron, is that there is really no trust document. Do you see that? There's nothing here that actually tells Allison how to spend the money. Okay. And so, Neil, that's the question I don't know the answer to. I don't know what the answer is. Nobody does until we go to court. So I can see, okay, so Jennifer, I don't think they would ask you if this was right or not. It's more likely that they present this scenario and say, how could you prevent this? Okay, so how do I detail that? How would I actually prevent this question from becoming material? Okay, that's why you might want a will. So this is exactly why you might consider this alternative. Okay, maybe mom and dad name each other as beneficiaries. Whoever's with me there. And then the estate is the contingent beneficiary, and the will includes the trust document, as Richard suggests. Okay. And now you can have much more definition. As to Allison's authority and responsibilities. Okay, this really significantly reduces Allison's risk. Yeah, you're going to pay probate on the $1 million or the $2 million, whatever it ends up being. That's going to be probatable. Okay. Yeah, that's fair, Scott. Your lawyer, and this depends on your province. This depends on the lawyer's sort of standard practice. But yeah, your lawyer had you write up a document for your trustee to say, you know, in a case like this, like my finishing the basement, here's what the trustee should do. Is that fair? You sort of laid out some priorities, Scott, right? You said, here's how we would prefer that our trustee spend or preserve assets. Okay. Yeah, and what's the harm in that, Baljeet? What's the harm that it takes what's going to be here? Maybe 6 weeks, 8 weeks to get that $1 million distributed. Do we need $1 million the day that mom and dad die? Because then, Devin, I don't have a trust document. The $2 million in that case passed outside the trust. Do you see that? It passed outside the will, passed outside the estate. It never lands in trust. Okay. I think, Jennifer, your question is very similar to what Devin's asking, and no, there's not a way that you can get that full description that you need and also avoid probate. Okay, even in your worst case scenario here, okay, in your worst case scenario, probate on this is going to be on $2 million, probate's going to be about $33,000, right? Okay, but Michelle, no matter what, do you see that I'm subjecting Allison to the risk of having to make decisions like that? So whatever decision you want to point to, I can come up with a scenario to create this conundrum if you want. Are you with me there? Okay. I'm not, what decision are you making here, Michelle? Okay. So let's say that you're right and there's funds in the estate to deal with that. I still have this $2 million. It's in Allison's hands, and she's still working with a lack of direction, isn't she? Michelle, did you solve that problem? Okay, that's all that I care about here. We can do all kinds of manipulations to show all the different possible outcomes here. I tried to just give one representative scenario here. Okay. Well, hang on to that thought, Baljeet, just for a second here. All right, so that's my first sort of conundrum. All right, the next problem. So I've got my beneficiaries here. Okay, so I got the kids as beneficiaries. So if there's no trust document, then at the age of majority, now this is not automatic, but at age of majority, if they become aware of their rights, okay, everybody's with me here? They can ask for, and they'll get it, okay? They can ask for their half of the trust. And Allison has no recourse against that. Which goes way, way back. I think, Chris, that was your point, like half an hour ago, that the trust just does not give us any protection against that. All right. Is everybody with me there? Now, once again, if I have a trust document in the will, okay, a trust document in the will, I can do things like, and I wouldn't just put an age restriction. This doesn't work in about 40% of the, in fact, exactly 40% of the provinces. So you would say something like the kids get, I don't know, whatever it is, let's say 25% at age 21 if they are in a post-secondary program with passing marks. Okay, then 25% at age 25 if they are buying their first home. Okay, you can set all kinds of provisions like that. Okay, so you can really sort of parcel the money out in smaller increments. You don't just want an age restriction here. You typically want an age and other condition. Okay, you can't do anything here that would be contrary to public policy. So you can't say they get 25% at age 25 if they haven't married a Polish person. Okay, that would not be an acceptable restriction. That's good. All right. There any questions there? No, in 40% of the provinces, Baljeet. So there are 4 provinces where you can just do a straight up age restriction, Alberta being one of them, and 6 provinces where you can't. And I can't remember which provinces are which, sorry. Okay, all right. It gives you much more control, Connor. That's right, that $33,000 spend gives you much more control. And in addition to that, Connor, depending what province you're in, I'll pick on Saskatchewan here. So if you had all of this happen in Saskatchewan and you named the kids as minors, the kids as minors, and you have a trustee here, there's a fairly good chance that the Saskatchewan trustee's office is going to say, no, get out of here, Allison. We're taking that money anyways. And they would most likely probate it anyways, even though you didn't plan to have it done that way. And now you get a trustee other than the one that you intended. Okay, that's good. That's been a fairly common outcome recently in Saskatchewan. No, the insurer cannot keep a trust document, Richard. There are very explicit provisions in the in the Insurance Act in every province that prevent an insurer from taking a role as a trustee, and holding the trust document can be perceived to be filling that role of trustee. Okay. Why does the Saskatchewan probate court get so aggressive, Shauna? Is that what you're asking? Honestly, it's just what they have decided. They figured that that's sort of in the best interest of those kids, right? So you might recall that the law generally is going to look after children, minor children, at sort of the expense of everybody else. And that very much fits with that way of dealing with this problem. Okay. That's good. Now, I don't want to suggest this is always going to turn out badly. It could very well be the case that Allison gets the $1 million, she has it in trust, she invests it well, she doesn't have any difficult decisions like the one I presented here. She parcels money out to pay for the kids' living expenses until they're adults. And then when they're adults, she talks to them and she says, look, kids, you're 18. There's lots of opportunity here for bad decisions. I would prefer if we just keep the trust intact, and I'll pay for your educations. I'll pay for you to have a place to live. When you're 25, then I'll give you the rest of the money, or something like that. And the kids might be perfectly fine with that. Okay, that doesn't change anything, Baljeet. There's nothing preventing that at all. Okay, I don't necessarily think that's a wise thing to do. You end up with potentially conflicting messages from the two trustees that way, but who knows? Okay. I think that something parents should recognize here is that handled badly, this amount of money can really contribute to some very bad outcomes for these kids. Whereas handled well, this amount of money can really contribute to some very significantly beneficial outcomes for these kids. Okay. All right. Whew. That's a trust, isn't it? I think so, Scott. Let me check here. I lost track of what I have in my slide deck for today. Sorry. I don't specifically have the Henson Trust in here. I'll see if we can find a chance to talk about it. Okay. All right. Yeah, perfect, Richard. So it doesn't always go badly, right? I don't want to paint this as a horror story. Okay. I do think they should get along, Baljeet. I don't necessarily think they have to be the same person, but I think guardian and trustee should be people that have a reasonable relationship with one another. All right, I'm going to get rid of this slide. Okay. And then we'll talk about taxation. Yeah, I mean, when you have a divorce, then you have to go back and redo your estate plan as well, Baljeet, right? Okay. So we're going to look at taxation of trusts here. Now, it's not really trust taxation that's complicated. Okay, trust taxation by itself is pretty simple. It's our normal set of tax rules that are complicated. So in my simplest scenario, I'm going to have a trustee, my settler, I apologize, my settler, who settles the trusts. Okay, and now I'm going to have my trust here. And then I have my beneficiary or beneficiaries, doesn't matter. All right. So the first thing is, when my settler settles the trust, this is a change of beneficial ownership of property. Therefore, we're going to have a disposition, which is going to trigger any capital gains. Is that fair? Now, there are some exceptions to that. And this has nothing to do with trusts. This is just, in general, how this works. So the exceptions would be if we can take advantage of a spousal rollover. So we have a spouse putting assets into a spousal trust or joint spousal trust. Well, in that case, a rollover applies, and therefore there's no tax. Is everybody with me there? Okay, if we have an alter ego trust or any other trust that's for the settler. Yeah, it's true. There's no, now, in order to be a qualifying spouse trust, Devin, then we have a different set of rules. So hang on to that question. I think you're asking a different question here. We'll talk about qualifying spouse trust in a couple minutes. All right. So in alter ego trust here, there's no change of ownership. Still for the same person. So no disposition. Is everybody with me there? Or another time we have a rollover is if this is a transfer of farming property, transferred to a spouse, child or children, or grandchild or grandchildren. Okay. Okay, so again, you're asking exactly the same question, Devin. That's exactly the same question. Okay. So yes, the true alter ego trust, again, you have to be 65. Okay. All right. But that's not what I'm concerned with here. All right. So then here, you would have a rollover with no trust. This goes back to Chris's comment earlier that a trust is a flow-through entity. So I would have a rollover with no trust. So I have a rollover if I'm using a trust. Okay, is everybody good there? No, no, that's the parent has to have farmed the farm, but the kids don't have to. Okay, and if the farm's been in the family since 1987, since prior to, oh no, I can't remember if it's June 30th or July 31st, Connor, but whatever it is, the summer of 1987, then that may not even be true. Okay. Good. So it really is just that question of farm property. Right, that's true, yes. If the kids or the trusts, in this case, sold the property. No, there's still capital gains. They can just use their exemption, Connor. Okay, the question would be about the access to the lifetime capital gains exemption. Okay, and your lifetime capital gains exemption, it's only $1 million. On most of the farms I know of, that's not going to be enough to wipe out your capital gain. Okay. That's good. I know some farms like that. I know you get people who have sort of scrub farms or small inherited plots, but generally speaking, somebody who's actively farming probably is actively farming a farm that's worth well over $1 million. Okay, so my settler settles the trust. Now we have, and I'm going to just ignore the trustee. The trustee has no tax consequences, so I don't care about that person. So now I have the property in the trust. And this property is broken up into two components. We talked about the capital of the trust. That's any tax paid amounts. And we talked about the income of the trust. And that's amounts that are earned that have not yet been taxed. Okay. So for example, let's say that the trust owns an apartment building. And it has a fair market value of $3.8 million. Okay. And it generates income this year of, net income. So net of expenses, we're going to have income of $110,000. Okay. So the $3.8 million, what we call the capital of the trust, and the $110,000, what we call the income of the trust. Does that work? So now the trustee decides how to allocate that $110,000. That's down to the trustee, and they have to do so within the terms of the trust. So the trust might be more restrictive here, but the trustee decides how to allocate the $110,000. So we can distribute it to whichever beneficiary within the terms of the trust, and then the beneficiary pays the tax as if they had directly earned that rental income. Okay, or we can retain it in the trust and then it's going to be taxed at the top marginal tax rate. All right, does that all make sense? I will show you 2 exceptions to that in a few minutes, but we're going to finish out the basics first. Or let's say that the trust owns $1 million of shares of Power Corp. Okay, just for the sake of argument here. And that means we're going to have capital of $1 million. Okay, and then it pays a dividend this year of whatever it's going to be, $37,000 or paying for dividends, but let's go $37,000. So that's going to be income. And same thing, the trustee allocates that to the beneficiaries. That's going to pay, that would be an eligible dividend paid from a publicly traded Canadian company. Okay, so we pass that to the beneficiaries. They get a T3 showing $37,000 of eligible dividends. Okay. Does that make sense? Is everybody with me so far? Now, if the trustee elects to retain the income in the trust, okay, pays tax at the top marginal tax rate, and that then becomes capital of the trust. Okay, are we all good so far? Now, the next thing we have to look at is what's called the 21-year rule. And I know a couple of you already wanted me to address this. So the 21-year rule says that any capital of the trust must be deemed disposed every 21 years. It does not mean the trust has to be wound up. That's a different rule, okay? In fact, a trust can go on for around 120 years in most cases. It's the lifetime of the youngest beneficiary plus 20 years is generally the rule. So this doesn't mean the trust has to be wound up, but it does mean that the tax has to be paid every 21 years. So I'll show you an example of this in a minute, but my exceptions here would be for any sort of qualifying spouse, joint spouse, alter ego, common law partner, or joint common law partner trusts. Okay, and with those types of trusts, as long as the settlor was age 65, it depends how the trustee allocates that income, Kamal. Okay, if the trustee allocates income to the beneficiaries, then yes, they pay tax on it. Okay, if the trustee retains the income, so yeah, so Trevor, remember I said I'm going to show you a couple of exceptions here. Okay, QDT still has the 21-year rule, Trevor. It doesn't get away from it. Okay, all right. Yeah, same deal here, Kamal. No difference for a minor. Okay, and attribution rules, any normal attribution would apply. Okay, as we've already mentioned. Okay, Lauren, do you have a question? Oh, I think you just unmuted yourself by accident, Lauren. I'm going to throw you back on mute here. All right, if you do have a question, just come off mute and ask. That's fine. All right, so in order for this to be true, the settlor must have been age 65 plus, okay? And the trust was only for them and or their spouse or common law partner while both were alive. Okay. Other than that, we're going to have this 21-year rule apply. Okay. Does that all make sense? Okay. So now let's look at this apartment building. So I have a trust that was settled in 2020. Okay. Now it's 2040. We're going to assume that no tax rule has changed between now and then. So I have a trust settled in 2020. Now it's 2040, and the trust owns this apartment building. And the apartment building has a fair market value now of, let's say, $7 million and an ACB of 3.8 million. I know that's not fantastic growth. I don't really care. And we have these shares of Power Corp. And we've got a fair market value of, let's say, $3,100,000 and an ACB of $1 million. Okay, everybody's with me here? Now, what I could do is just wait till next year. So if we still hold this property next year, that's going to trigger the 2020 or the 21-year rule. Okay, so if held for another year, we're going to have a $3.2 million capital gain on the apartment building, plus we're going to have another $2.1 million capital gain on the shares. Okay, which means the trust is going to have $5.3 million of capital gains. Oh, sorry. No, where's 2.2? Come on, what's 2.2? Isn't that 3.2? I'm sure that's 3.2. Okay. So I do sometimes make basic math errors, but I'm sure I've got that one right. All right. So okay. So I've got $5,300,000 of capital gains that the trust would have to deal with. Okay, so the trust would probably actually have to sell the Power Corp shares. If that's the only property it owns, the trust would have to sell the Power Corp shares in order to deal with that. Is that fair? Okay. Or what we could do, okay, is just transfer those assets to the beneficiaries. Okay. Yeah, still 50% inclusion rate, Baljeet, and then taxed at top marginal tax rate. Okay. So I transfer assets to beneficiaries now. Now, this is actually not even really a change of ownership. So it's true, Shika, we could pass that tax burden onto the beneficiaries, okay, which might not be ideal for them, Shika, right? They're not getting any money, they're just getting a big tax hit. They might not appreciate that. Is that fair? Okay. So, or we can transfer assets to beneficiaries now. Now, if we do this, okay, if we transfer assets to beneficiaries now, then there's no disposition because there's no change of beneficial ownership. Okay, so the kids would, or the beneficiaries would just inherit this property at the trust's ACB. Okay, is everybody with me there? because the beneficial owner of that property before we made that transfer was the beneficiary, and the beneficial owner of that property after we make that transfer is still the beneficiary. Okay, I have not changed beneficial ownership, I've only changed legal ownership. And you might recall when I introduced trusts last time we're together, I said what a trust is really doing is separating out beneficial and legal ownership. So I have not here changed the beneficial ownership, I have only changed the legal ownership. A change of legal ownership under Canadian tax law does not result in a taxable disposition. Okay. Right, that's the trust ACB, Jen. The ACB, when the property went into the trusts, okay, is still the ACB now. Okay, that's when I say that the trust's ACB, that's what that means, right? So now, if the kid sold that property or the beneficiary sold that property, whatever, next year, that's when they would trigger that full capital gain. So the gain didn't go anywhere, it's just deferred, right? Which is exactly the same thing that would have happened if I had just given the property directly to that beneficiary 20 years ago. You see that? So if I had transferred the apartment building to the beneficiary directly, no trust, no nothing, in 2020, and the beneficiary sold it in 2041, they would have exactly the same tax consequences. Is that fair? Sorry, I'm not sure what you're asking me, Devin. Are you asking, I don't know how else to say there's no disposition there, sorry. But it's not a benefit, Shika. It's exactly the same thing that would have happened with or without a trust. Okay, right. So the benefit here, Baljeet, was not a tax benefit. It was a control benefit. Okay, so you're talking about back on the bottom left here in green, Devin, right? You're talking about over here when we had that disposition. Okay, who did the disposition? Who is actually disposing of that property? Is it? Yeah, it's the settlor, it's the parent or whatever the case is, right? Therefore, who has the taxable event? It's the disposer, right? It's the person who's doing the disposition that has that taxable event. So the settlor, that's it. Okay. Oh, there, okay, that's good, Shika. All right. Yeah, that's exactly it, Ron. It's about control, okay, which is where we started, right? So if you're coming to that realization with me here, I hope everybody is, that I got zero tax benefit from this, okay? All my benefits were related to control or ownership or trust. Okay, then you're in good shape. If you're thinking that there's some tax benefit somewhere on this page, then you've misread something. Yeah, you can, Ron. You can have a corporation as a beneficiary of a trust, and you do see that sometimes in more complex family trust situations. Right. So Baljeet, if you're surprisingly named as a trustee and there's no compensation for you, just like an executor, you can say, no, thank you, I will pass. Okay. It's a reason why you should be talking to your potential trustees when you write the trust document. Okay. There you go, Baljeet. All right. That Aunt Baljeet doesn't work for free. Very difficult, Shika. Very difficult to do that. Not impossible. Okay. Yeah, I think it depends on the circumstances, Michelle. I think if it's for your parents and you're the sole heir, I would be okay with it there. But any other circumstances, that's tough. Yeah, I promise you, Shika, it was not an easy thing for that person to do. Okay. Yeah. All right. Are we all good here? Okay. Well, no, they're held for another year, Devin. So it's two different scenarios. Do you see the first scenario, held for another year, and the second scenario, transfer to beneficiaries. Okay. Okay. Difficult, Vashali. Typically, trustees cannot lend assets at all, whether it's to a beneficiary or not. That's typically offside. Okay. All right. That goes back to the prudent investor rules, Vashali, or the prudent person rules. Okay. And remember, I said you typically can only buy bonds that are investment grade bonds. And a bond is effectively a type of lending. That's the type of lending that you're okay to do. So I guess if your beneficiary was a AA rated corporation, you could probably lend them money. Okay. I'm not sure. It would just be before the 21st year, Trevor. Okay. And you see how this takes us back to the informal trust versus formal trust discussion, because I want my trustee to have the ability to tax plan. And with the informal trust, there's very little ability to tax plan. Whereas with the formal trust, I most likely will have a clause in there that's, or a few clauses that specifically give my trustee the ability to do some tax planning. No, I don't think that's right, Greggy. I don't know why you would say that, honestly. I'm sorry. It's ACB to ACB. I don't even really understand what you mean by transfer at fair market value. It's just going to retain its ACB all the way through. Okay. All right. Okay. So I think we'll take a break there. I'll come back after a break. I'll talk about two tax structures that do give us a little bit of tax benefit with trusts. And then we're going to go into the homework just to make sure we have time for it today. And then time permitting, we'll do multiple choice. We might do a little bit other trust stuff afterwards. All right, so I've got 6 minutes to, let's take a 15-minute break. We'll resume then at 9 minutes past. Okay, perfect. We'll see you back then. Thanks.